Hi, this is the Everyday Economist, and today I will be going over this graph that I actually received in two separate emails, both of them asking me to go over it and make a video explaining it. Not sure where this graph is from or who made it, but it's a neat little summary of how the secondary market for US Treasury works. And to understand this graph, you have to first take a step back and understand US Treasuries and even the primary market, because this is the secondary market. And if you've been watching any of the videos on this channel, you obviously know that US Treasuries is a very common topic and theme for discussion. So just to recap, US Treasuries are debt securities essentially issued by the US government, and they fund all sorts of activities from subsidizing social programs, government spending, and it basically allows the U.S. government to function. And they're essentially considered one of, if not the most safe and sound financial asset in the world, because they are essentially backed by the full faith and credit of the U.S. government. And they again not only play a crucial role in domestic U.S. spending, fiscal policy, monetary policy, and objectives, but frankly globally. And I've made a few videos discussing the not just global financial impact, but also even geopolitical impact that the primary U.S. Treasury market has. And speaking of the primary market, again to recap, that's where new treasuries are first issued by the U.S. Department of Treasury. And they're sold usually what's a thing called an auction. And you have investors, typically large institutional investors like banks, insurance, mutual funds, pension funds, and also importantly, foreign governments involved in it. So again, if the US government needs to borrow, say, $1 trillion, it can auction new treasuries in the primary market. And the secondary market comes into play when now you remove the treasury from the picture. They're no longer the seller, so you have an investor selling to another investor, hence the name secondary. So it's the second purchase and resale of those treasuries. And the secondary market is as important as the primary because it again provides liquidity, provides validity to the primary market, and it allows other investors to buy and sell treasuries even without waiting for them to mature. If they're 10-year, 5-year, 2-year, what have you, they can just sell and resell and make a quick buck without having to wait to the maturity date. And this is what the graph focuses on, so I'll go over this. But before I do that, a few of the comments I got and a few of the emails I've been getting seems to me a lot of people using these terms like treasury bills, T-notes, T-bonds interchangeably. And although, you know, if you're speaking in general terms, it makes sense, it's actually not correct to be very technical here. Because when we speak about treasury bills, or T-bills for short, they're the short-term securities that mature in 1 year or less. Then you have the T-notes, the treasury notes. They're what you consider medium term. They mature between 2 years and 10 years. And treasury bonds, which are T-bonds. And they're the long-term securities, you know, the 20-year, 30-year. And it's important because when you hear about yields going up, the yield curve inversing, and people panicking or getting reassured, you have to understand the difference, because if a reaction happens in the short term, T-bills versus the T-notes, it has vastly different implications for how the market is pricing in recessions at a 2-year, 5-year, 10-year, 20-year window. So with that out of the way, let's focus on the primary market and get to this graph. And we can start obviously from the top left, and these are your treasury customers, both in the primary market but also in the secondary market. They're the common denominator between the primary and the first one. So you have the hedge funds, the asset managers, corporations, pension funds like CalPERS, which I believe is the California Pension Funds for public sector employees. And you have insurance companies. You also, you know, if I can make a change, I would also add, you know, foreign buyers as well. And one thing that I would also change is it seems to lump all these different buyers into the same group, which is, you know, correct, but they're vastly different window horizons for each of them. Like an insurance company or even a pension fund is not going to be looking at the same uh, maturity dates as like a corporation is, or even a hedge fund. The hedge fund is going to be very short term, looking at pricing arbitrage mismatches, so they have different objectives, but that's besides the point. So when we think about the first part, you have over here the trade execution. So it's dealer to customer. Over here, the RFQ, which as you see in the parentheses is request for quote. And essentially, these institutions go to the market and say, hey, I'm interested in buying or selling these many treasuries, and this is a range of prices I'm interested in. Give me the best price you can, either for buying or for selling, and that's an RFQ. You're basically saying, give me the best price. Now, this could happen on two platforms, as you see denoted here, SPDs and MDPs, single dealer platforms and multi-dealer platforms. And that's very simple, despite the long name, is in a single dealer platform, the customer works directly with one another. You can have such like a Goldman Sachs. The pension fund picks up the phone, calls Goldman Sachs. That's one-to-one. That's a single dealer. But in a multi-dealer scenario, you have platforms like Bloomberg or TradeWeb, and they aggregate and collect all the quotes from multiple dealers, and therefore you can compare prices. So think about it as going to a car dealership. You can go to multiple car dealerships and say, give me the best price you can for this Toyota or for this Honda. So you're shopping for prices in a multi-dealer platform, whereas in a single dealer platform, you might have an established relationship, and you might work with one Goldman Sachs or one of these institutions to get the price you're looking for. And once the customer completes a trade, they often use what's called an interdealer market to adjust their inventory or manage risk. And this little part over here is also, I guess, not so relevant. You could do it by voice or email. It makes sense, but the graph, it's a little bit confusing how it flows, but I believe the next appropriate step would be here, the interdealer market. And they allow basically dealers to trade U.S. Treasuries with each other and with the principal trading firm, which is here. So it jumps to here. And a PFI, it essentially ensures that dealers can balance their positions, but also provide liquidity to the overall system. And the key participants here, under here, you see the security dealers, they trade with other dealers. So you might have a Deutsche Bank dealing with a Goldman Sachs saying, hey, I got this order coming in, but I don't have the inventory. Can you provide me some? So in the behind the scenes, the dealers might deal with themselves. So think about it that way. And the PFIs, I would categorize them as, these high frequency traders that you might have heard about, and really market makers like Citadel Securities, who continuously, instantaneously, essentially quote prices and ensure liquidity. So this is like the back engine that ensures whatever the treasury customers are looking at, there's always a flow coming in and out. And how a trade really happens, going back here with this arrow, we jumped from here to here, now going back to the trading platforms. You basically have the central limit order books, the CLOBs. And they're really transparent platforms that automatically match buyers and sellers. They're no different than when you go to buy and sell stocks on an Interact broker on your internet browser. It's pretty much the same thing. And you can also do it through a non-CLOB system like voice trading, way more common before the internet. And it still exists today. Pretty much everything is CLOB, but for non-CLOB, you can think of it as if you have a really complex trade, like a block trade or thing you want to get through, and it's not as liquid, you pick up the phone and you call your single dealer platform. Essentially, that's what it's for. It still does exist, but it's not as ubiquitous as it used to be back in the day. And this again is like the primary dealers here in these two boxes, the one on the left and the one on the right are the same thing. So they just flow into this middle box and the deal is settled. Now, once it's, in the process of getting settled and cleared, then we focused on the second bottom of this graph, the bottom half of this graph, which is clearing and settling. And this is important because now let's say you've gotten your deal through. So clearing is someone saying, someone reads out the deal, confirms these are the prices and the quantities both the buyer and the seller are interested, and essentially think about it as validating the process. And it's confirming the trade. So again, it says, are both the buyer and seller in agreement on the details? And this step eliminates any mismatch. They do happen, miscommunication happens, so it's an important step. And in the dealer to customer market, essentially you have clearing banks validating trade details and thereby acting as the intermediaries between both the customers and the dealers. Whereas in the interdealer market, remember that market, the dealer to dealer, there's also clearing there, right? Because if the dealers are saying, I'm looking for liquidity from another institution and they're negotiating, they have to sometimes step in and guarantee these trades and ensure that the back end is all smooth so that the main dealer can ensure that their customer can get what they're looking for, either in price or quantity. So that's another important thing behind the scenes. And then after it's cleared, we get to settlement. And settlement ensures like the trade is finalized. With ownership transferred, now it's transferred electronically, and payment delivered. So payment and transfer of the securities is actually done. That stage is called settlement. So that's the thing here and denoted by this one here. And the key players in this overall system, you can again see, another thing I would change is the Federal Reserve. I would move it to the middle. It's really important. They're the key players. And they operate this thing called the book entry system that transfers Treasury securities. And they also manage this real-time, I'm not sure if it's here, but they do manage the real-time gross settlement, RTGS, of cash and securities through their system, which is actually here the FedWire, which, you know, the closest comparison is not the perfect, but it does help understand. You can think about it as like the general ledger that we use for Bitcoin. It's this transparent system. You can see the deals, that the prices agreed upon, and it helps with price discovery, and it helps with transparency. So the Fed has its own thing called the FedWire. It's kind of like their own ledger where they disclose all the trades going through. And then you also have the clearing banks, the middle section over here, BNY Mellon, and their institutions that they also facilitate the exchange of the system. And in the far right, you have the FICC and the Fixed Income Clearing Corporation, and they basically guarantee the interdealer trades, and they act as a central counterparty, like a CCP. That's what they mean. So they're essentially guaranteeing the trade to make sure it happens. It provides a sense of assurance and trust in the system. You also have over here, again, flowing into the central system, the CBES, the Commercial Book Entry System. And similarly, this also maintains an accurate ownership record. So at all times throughout this process, you know who the owner is from the time the transfer happens, even before and leading up to it. And it also ensures that if you're a buyer, if you're a seller, you can account and also update in real time after settlements happen. Okay, this person now owns it. I've moved it to their own. So it helps with, again, price discovery and transparency. So taking a step back, if you want to think about like a step-by-step of a flow of a trade, so let's say a pension fund, we're a pension fund here. We want to buy $500 million in treasuries from a dealer A, for example, in the dealer to customer market. And dealer A sets part of this, sends this to dealer B in the dealer market to ensure that they can actually fulfill that trade. They're interested in working with the pension fund, but they also got to check with other dealers if there's any shortages that they have in their personal inventory to make sure that there is. So now let's assume dealer A is good to go. So then we get to the clearing stage. And these are where the trade details are validated by one of the clearing banks in the bottom. And they verified, a lot of lawyers and bankers involved to ensure, again, hey guys, this is the price you wanted, right? It's 500 million, not 501 or 499. This is the quantity you want, correct? Good, let's go. And then the FICC guarantees and it reduces risk essentially. So it's a really important stage, often overlooked. People even sometimes use clearing and settling as interchangeably before, when you're talking about the large sums of money at play here, it's actually a very important and distinct stage. that gives the U.S. system, the behemoth of the U.S. economy, a great deal of transparency and trust. This is why people go to the U.S. to buy their treasuries, not to other countries. Their preference is always USA #1 because it comes out to trust, transparency, and clarity. And this is part of it, this system that we see here. Now, that was clearing. Also, settlement is important. And that's where the Federal Reserve transfers ownership of the treasuries electronically, even in a secondary market. And the clearing banks ensure that the cash is also transferred security. So you can think of it as where the actual exchange, the exchange in the hands happens. And once the dust settles, the ownership record has to be updated with the CBES over here, the book entry system, and they complete the process. So you see how this whole thing works as a whole. And taking a step back, it's important to understand that the secondary market actually arguably has more impact and a far-reaching impact on global financial markets, both domestically and also internationally, than the primary market. Primary market is obviously extremely important, but a lot of the headlines you read and a lot of the bullet points you read on the news about yields and the stock market reacting to bonds and even geopolitics, when the videos we have on this channel that we discuss about China and geopolitics, really comes out of this, the secondary market, and this is essentially what you see. And frankly, understanding the underlying mechanisms and players involved is important. You really can't call yourself an expert or even speak on this subject matter at a holistic level if you don't understand the underlying mechanisms and why the United States over other countries is seen as the most favorable place to park cash for not just individuals but countries that have trade surplus like China. And this is the reason. This very delicate but highly organized, sophisticated, and more importantly transparent system gives credibility not just to the peace of mind that individuals have with the large sums of money they're parking here, but also for price discovery. You're getting a fair deal. There's no missing features or aspects or variables that might make it seem you're not getting the best profit or the best price or the best deal, because it's the closest thing we have to a very institutional open source network. It's a very great system, and that's what gives it credibility. So when we talk about the U.S. economy, it's not just that the U.S. economy is the most innovative and their stock market outperforms, that everyone wants to send their cash here. That's part of it. Or even if the United States is raising interest rates while other countries like Canada cut interest rates. So, where do you want to send your money? You want to put it in the U.S. saving account, and therefore America seems to track. That's part of it. But another part of it is the organs, the veins of the system, how the system sustains itself. That's also a fact that's important in the United States' ability to attract capital, vast amounts of capital. So people saying that the US dollar is going to be replaced, and I've made similar arguments in this channel. It's not as easy as simplified as that. I'm not a believer that the US dollar will get replaced anytime soon, because even though the dollar has many flaws within the concept of it, since leaving the Bretton Woods system, the fiat system, there's a lot to criticize. But the underlying mechanisms, the superstructures, if you will, the system that runs it, this is hard to replicate. Even if you have BRICS or other countries trying to replicate another currency to do trade with, it's really hard to replicate a system like this, because that credibility, that trust, not just takes years to build, but it also needs continuous oversight, continuous players maintaining trust and balance within it. And that's a very hard thing to replicate for any new country, any new player, any new system that wants to supplant and usurp the US dollar. So to the viewers who think that the US dollar is done and buried, I say think again. It has a lot of flaws, and it will do a lot of recalculation and reassessment of itself, and, if you will, soul searching, but it's far beyond done. And it's because of systems like this. So don't be so dismissive about the US dollar. Now, this is a neat graph. Obviously, there are a few flaws. It's not as detailed as I would have hoped it to be, and I would have moved a few things around, like putting this in the center or clarifying the different trajectories of investment for different players in the customer section. But overall, it's a neat graph. Thanks for sending it. And if you have other questions and concepts you want me to go over, and if I can, I will be happy to do it. Send them my way. Thanks for watching.